Hey everyone, how's it going? Hope you guys are having a great day so far. Good morning, Marlo. I can't see the whole name. Sorry, Marlo. Good morning, Marlo, Wade, Jill. Great to see you all. Let's see, let me start sharing my screen. Hey, David. When I share my screen, I always lose the chat. Let's, I gotta figure this out. Okay. I think I'll keep you. Where can I see you easily? Maybe over here. Okay. All right. Jill, David, Cyrus, Catherine, Devon, or I think, hopefully I'm saying your name correctly. David, Devon, Anthony, Chris, Dennis. Good morning. Good morning. Let me get the chat on YouTube open as well. And hopefully volume's okay today. All right. Hi Pete, hi Daniel, hi Health, Wellness and Prevention, and Kevin. All right. Okay, good, thank you. You guys can hear me good. All right, Carrie, Eduardo, excellent, excellent. Richard had to leave had to leave the other room. Okay, awesome. If you guys aren't already part of my Telegram, please join. I do send every once in a while some tidbits about Gamma. Today I said, hey, Gamma is showing us 620, 615. At the moment, at the time, the market maker was showing a much tighter range at, I think it was 618, 616, but I'm sure they've changed their range by now because we've traded way through that. And then starting next week, I am going to be doing live aftermarket sessions, and I'm going to be going over a lot of things that you probably never heard of, because as far as I know, no one's doing aftermarket stuff. Like, what do you do after the market's closed? You're like, oh, market's closed, great. Just walk off. Well, I never did that as a pro when I was more managing portfolios and managing books. We never did that. We had a whole closing procedure that we did, and then that prepared us for the next morning. So I'm going to be going over like that, sort of like Roger has shared with you his morning routine. I'll be sharing with you my afternoon routine. So if you want to join me there, youtube.com/gamma pockets. Okay, so I don't know if you guys can see that, but that's YouTube. Maybe I'll type that in for everyone. Okay, so starting next week, I'll be about 15 minutes after the market closes, I'm going to start my session. Okay, and is there anything else? I don't think there's anything else. Okay, all right, so let's take a look at what's going on. I actually have a pretty interesting, at least I think it's a pretty interesting topic, and I don't think anyone is talking about it as well. Probably not something that you've heard before. So we got some exciting stuff. This is going to be interesting because I'm always watching the market after it closes. Okay, awesome. All right. Hi, Joe, in San Diego. Okay, that's not too far away from me. I grew up in San Diego. Okay, so what I'm going to talk about is one of the factors in setting yourself up for success, and that is recognizing the trading environment that you're in. And when you go through a morning routine like the one that Roger goes through that he shared with you, what he's trying to do is establish exactly what type of trading environment that he's in. So he has these certain things that he looks for step by step in order to establish that every single day. So I'm going to share with you one of the things that I do. It's not the whole thing. I'm not going to share my entire routine here because that would take a very long time, and you probably already see a lot of it. A lot of it's going to overlap with what Roger does. So there's certain things that professionals just do, and there's a couple things that I picked up from Roger as well. So those things are exact same. So I want to share with you something that I do that is completely unique, or at least I've never seen Roger or anyone else do it. And it is definitely something that that professionals at Wall Street will pay attention to. And I don't want, when I said that, haven't seen Roger do it. I haven't seen him put focus on it. I haven't seen him put a lot of time and attention on it, at least not when he's sharing it with you guys. So I wanted to give it the attention and expand on exactly what we're looking at. I need more subscribers and videos. Yeah. Well, we're gonna start ramping up the number of videos for sure. Yep. Okay. Should I have exited healthcare as going down? XLV. CTS broke support, so it broke that MA50, and then it looks like it might find some support again at 212-ish, and then at the MA100 here. Okay, CTS, I think that's one of, at the beginning of 2025 or at the end of 2024, I'm pretty sure this was one of Roger's, like his most hated stock. I think it did dump and then actually 2025 had done pretty well, but it doesn't look so great at the moment. Okay, so let's take a look at, so what I want to talk about is figuring out whether the market conditions are favorable for you. And one of the most important things that I look at in order to determine that is the VIX. Okay. So has anyone heard of a volatility regime? Do you guys know what a volatility regime is? Anyone heard of that before? Let me get this split on my screen. Come on. While I wait for you guys to type and respond. I'm having a lot of trouble these last couple days with my mouse. Okay. Okay, let's see what you guys are saying. No, yes, no. Heard it before, never had it explained to me. No. So mostly no. Oh, okay. I mean, I've only seen like 2 or 3 yeses. So volatility regime. Good. Got to get way bigger than this. A volatility regime is basically different characteristics based on what volatility is in the markets. Okay, so characteristic of markets when volatility is behaving a certain way. Okay, so why is this important? Well, if we take a look at something like the VIX, this is the market expectation, and specifically the market maker expectation on volatility over the next 30 days. Okay, so the way that they calculated it is they take the options, the at the money options, around 30 days out. So 20 something all the way up to 30 something days out. They do some sort of averaging, some sort of calculation, and then they come up with that VIX number. Okay, so what's important for us is it tells us market makers. So everyone always says it's the market's expectation, but the market has zero control over implied volatility. The market maker has 100% control over implied volatility. So it's actually the market maker's expectation. I can't type. Okay. So it tells the market maker's expectations of turbulence, okay, over that time period. Okay. So when we have higher implied volatility, that means higher VIX, and that means more turbulence expected. Okay, not necessarily that we're going to get more turbulence, it's just that we're expecting more turbulence. Who and what are the market makers? Oh, that's an interesting question. Market makers are institutions that apply to the SEC and CBOE to do what is called making markets. So a market maker's job, and they are required in order to be a market maker, is to, on every single option provided, and there are market makers for every asset. Okay, so we're talking about the options market makers right now, but there are market makers for stocks, there's market makers for bonds, there's market makers for basically every single asset, at least every single liquid asset. So these market makers, they're institutions, they're financial institutions, and they apply to become a market maker. And with the approval comes legal obligations. And if you're the market maker for MU, then you say that, and there could be more than one market maker for MU. There's at least one of them, but you are legally bound to, on every single option listed, to have a bid and an ask for those options, which means that it's a guaranteed transaction price, legally obligated quote. So if I want to buy this 123 call option expiring July 18th on MU, and I say, okay, I'll buy it at 410. Then the market maker is legally obligated to sell it to me at 410. Why? Because they said they were willing to sell it at 410. If I go and I say, hey, I want to buy this one, and I'll buy it at $4, then they're legally obligated to sell it to me at $4 because that's their advertised price. Okay. What if I want to get it at 405? No guarantees. They might do it, they might not do it. It's completely up to them as to whether or not they want to do it. So as long as we go in at the bid or ask, the market maker is guaranteeing a transaction. And what that does is it provides liquidity to the markets. So it means that you can always buy or always sell any given asset, as long as you're willing to meet that price. So it's not like I have, hey, is there a market for this pen? I'm sure someone somewhere would be willing to buy a pen. I just have to go and find that person, but I might look long and hard, and they might go, hey, that pen came from whatever bank. I could just walk over there and get a free one. Why would I buy your, right? So there's no guarantee that I can transact on any given thing. There's even your cell phone or a cup or whatever, there's not necessarily a guarantee that you can transact. If you go to a store, they have a sticker price on every item, and that guarantees that transaction price. They have zero wiggle room, and they're only sellers. They're not buyers, right? So they only have an ask. They don't provide you a bid. So if I go to a grocery store and I say, hey, I want a tub of cream cheese, they will tell me what that price is that they're willing to transact at. And if I like the price and I want to buy that cream cheese, then I'm going to pay that price. But if I had a tub of cream cheese, I can't sell it to them. All right, so unless I bought it from them first, I could return it. But I can't do that. So the market maker guarantees that you can sell or buy. So that's the role of a market maker. Okay. So a market maker can screw all options buyer by keeping stocks below a call price. Now, that is a common misconception, okay? The market maker does not have any control over the underlying stock price, right? So unless they happen to be a market maker for the underlying stock as well, which is rare, they shouldn't, or I shouldn't say rare, it should be impossible. It's not The CBOE and the SEC will not allow that. Okay, you can't be a market maker for both the stock and the options. You could be a market maker for a different stock and options on a different stock, but you can't be the market maker for the same stock and options. Okay, so that's a common misconception. So a lot of people are, oh, look, the market makers sold 10,000 or 20,000 of these 120 calls. They're going to do everything they can to push MU's price below 120 so they don't have to pay on these calls. Wrong. 100% false. Myth. This put out by people who have absolutely zero idea what a market is, what a financial market is, and how it operates. Okay, so do not buy into that myth. Whoever tells you that doesn't know jack crap about markets and has no real experience, no real professional experience. Okay, it is 100% false, and I'll tell you why. The moment the market maker sells this option to you, you say, hey, I want this 120 call, instantly they're going out and they're hedging it. So this market maker literally does not care if they have to pay on all 22,000 of these contracts. Why? They're hedged. They're going to make their money. Right? If they have to pay you $3, I will bet you my life savings that they're hedged for $3. They're not losing that. They're not losing that money. The market maker very, very rarely loses money because they have to pay out on an options contract. They have to, someone had to mess up, or the market had to shift in such a fast way that they had to be caught off guard and they couldn't hedge themselves in time or hedge themselves properly. Okay. So it is very rare. So, and the market maker has absolutely zero incentive to push the underlying stock one way or another because they're perfectly hedged. So that is completely 100% false. And assuming that they could push prices, how would they do it? They would do it by buying or selling the underlying stock. So how would they push this below 120? Sell, 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 sell. They would have to have a huge inventory of the stock on hand, and they would have to sell a huge number of stocks to start pushing that below 120. And then great, they don't have to pay you on these contracts, but and then they sold at 123, 122, 120, 121. But if they had such a huge inventory, they're definitely not selling their entire inventory in order to push it below 120. And now the leftover inventory is marked down. And now it's worth even less than it was before. It was worth 123, and they purposefully devalued the rest of their inventory down to 120. That doesn't make sense either. Okay, so don't buy into these myths that the market maker is going to try to push stock prices one way or another. Okay, the only thing that they will do or could do is widen or tighten the bid-ask spread and say, hey, these 120s, man, people just keep on buying these things. I don't want to keep underwriting that risk. I don't want to have to keep hedging myself. Let's blow these way out. Let's make it $3 and $10. Oh, who wants to trade that? Not many people, right? We don't see a great example of that right here because of MU is highly liquid. But you'll see that in, I don't know, just pick a random stock. See, right here. $2.40 bid ask. Okay, so tight, 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 suddenly super wide. Okay, $1.50. How about this one? $1.50. Okay, over here, $2.10. They're getting wider and wider. One, partly because of the risk that they have, and two, because they don't want to transact these. Widen out the bid-ask spread. So that's the most that a market maker will do. Widen or tighten a bid-ask spread. Okay. All right. Are different market makers, will they have different bid-ask prices? Not these days, because everything's hooked up electronically. So if they had different bid-ask spreads, then someone could arbitrage fairly easily. I could go to this market maker and say, oh, this guy only wants $5 or $2 for this option, and he's willing to buy it for $1.85. Well, if another market maker is 10 cents off, and it's like $1.90 and $1.75, okay, then I have potentially an arbitrage because I'm guaranteed that I could buy it at $1.90, and I might be able to sell it to this guy at $1.95, potentially, maybe. So I might have some arbitrage opportunities. So the market makers are all in sync with each other, and they communicate digitally, electronically. And so the bid-ask spreads aren't really going to be too different from market maker to market maker. Too much arbitrage opportunities. Okay. What about the market maker range? Market maker, the MMM. Do they have the power to push it back into the range that they predicted? No, not really. Because it's the same thing. And especially, I mean, does a single market maker or a group of market makers have enough juice? And just say, I'm wrong. Kane, you don't know what you're talking about. These guys, they do it all the time. You know, the market maker move, they're going to push it back within their range so they don't lose a whole bunch of money. Oh, really? Okay. How much money do they have to have in order to push the S&P SPY even $1? How much money does that take? And do they have that type of capital? And if they had that type of capital, don't you think that we would be seeing, come on. I don't know why my indicators keep disappearing. Oh, SPY, because that's on VIX, okay? Do you think that you'd just be sitting at 50 million shares per day on average? No. You'd be seeing like hundreds, if not billions, hundreds of millions, if not billions of shares being transacted if the market maker was pushing things back and forth all day long, okay? So it's not happening, not even on the small stocks, because on the small stocks, you're not getting millions and millions and millions of shares being transacted. So everything that people have in their conspiracy theory minds is false, okay? That's not how markets operate. It's just not. Okay, so what could happen, again, is they can widen and tighten their bid-ask spreads. So what happens when the market maker loses money? Okay, I've talked about this before. I don't know if any of you have heard me talk about it, but look at this right here. There is a certain implied volatility on Liberation, the day before Liberation Day, or the session of Liberation Day, okay? And I guarantee you it did not encompass a 30-point move in the SPY in the next day, or an additional 30-point move the next day, or at the low right here, an additional 30 to 40-point move the next day, okay? So here, the market makers got creamed because no one knew Liberation Day was coming. We were expecting this ATR right here, this amount, this range of trading. That's what the market makers would have priced in. And so they got killed right here. Anyone who bought a put made a huge amount of money. The market makers were hedged for a certain amount, but not this amount. And so they got killed. And then they got killed again. On this day, they would have seen this. They started widening out those implied volatilities, but we had another one and they would have gotten killed again. And so they would have widened out those implied volatilities again, and then they would have gotten killed again. And then this happened, and then this happened. We went right back. They would have gotten killed on the other side. So 5 days in a row, 6 days in a row, the market maker gets creamed. They're protected with their hedging, but they probably, because they didn't anticipate such a huge move, they didn't, so especially on that first move, they're far less, they would have lost more money here than in other areas, because here the volatility spiked, right? VIX spiked up. Where's VIX? April, right here. You see that? All of a sudden, VIX just in a couple of days spiked all the way up. By April 8th, it was already up to 51. That's the market maker widening out their market maker move or their IV so that they can try to get a handle on and not keep losing money. But did they lose money in that week? The answer is yes. But look what happened next. Where did prices go here? Baby move, 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 all the way till now. After that 1 week, we had baby moves and then smaller and smaller moves. Okay, so after this, or maybe we could argue this bar right here, April 10th, everything went back to the same as this. These bars right here are no larger than these bars. This day-to-day movement, including the gaps, are no bigger than these right here. Okay, so what was VIX right here in March, and then in March, and then what was it immediately after, April 10th and after? Okay, so let's take a look at that. In March, volatility is kind of high and kind of low. We had that little spike right here, but it was coming lower and lower and lower. Okay. Immediately after April 10th, where are we? 36, 30, 30, 30, 30, 30. How long did it take to get back down here? All the way until May 10th. Okay. For a month, VIX was higher, but SPY was exhibiting the exact same volatility right here. So that meant implied volatility and options were really expensive right here for very little price movement. And so when the market makers made a big loss right here, they made a killing over here because they were selling overpriced options and people were just buying them because the market maker is the market maker. They set the prices. If you want to transact, if you want to buy a call or you want to buy a put during this time period, you want to bet on a V-shaped recovery or you want to bet that there's going to be increased movement downwards, well, you got a mild movement, steady movement upwards, not a V super. I mean, this is a V, but not like a super sharp angle V. Okay, so they made all their money back and then some by keeping VIX elevated for a month afterwards. That's where they made their money. Okay, that's how they make their money. It wasn't because they push prices back and forth. If the market maker loses today, I promise you, maybe they'll lose tomorrow again. Maybe they'll lose the next day afterward. Then maybe they'll lose a few days in a row. I promise you, the next month afterwards, they're more than making up for it. Okay, so they're not playing the same game that you think they are, because they're not thinking like a retail trader. They're like, oh no, I lost this trade. The casino in Vegas doesn't go, oh no, that guy won $10,000 in a hand of blackjack. Oh no, that guy hit a jackpot and made $1 million. They don't think that way. They go, congratulations, let me advertise on giant billboards that you won the jackpot for $1 million. Why? Because they're going to make it all back when 500,000 people come to their casino excited that some guy made the jackpot over there, hoping that they'll get it too. And they'll rake it in afterwards, just like the market maker. They rake it in the month afterwards because people are still scared. And they're saying, yeah, I'll pay for that volatility. I'll pay for that volatility. I'll pay for it. Even though the S&P 500 is doing exactly the same thing it was doing right before it. Okay. So that's how they make their money. It's not what anyone else has told you. All right. So we got kind of off topic getting, but I mean, it's very, very valuable information that you should absolutely know if you're going to be trading in the market. So Does that make sense to everyone? Let me see what you guys are saying. Why do prices change if you place an order at a bid or ask? They could change it, so they're obligated to fill you, and then they might change it, especially if you had a large number of contracts. If you have a tiny number, they might not care. But if you have a large order, a large number of contracts, then what they're seeing is that's information to them. That's supply and demand to them. And so, yeah, of course, they're going to adjust their prices. I love it when King spits truth on his hair. Okay. So is it a misnomer not to have stops on a position since they cannot be the market maker for the underlying and the option? If you have a stop on a position, okay, it's not that they drive the underlying price down, but what will happen is, especially at the opening volatility. So if you look at any symbol, including the SPY, right now, July 1 week SPY at the money bid ask spread is 2 cents. Okay, at the open it could be 5 or 10 cents, even on the SPY. Well, now if you're not looking at the SPY and you're looking at something else, like I don't know, I can't think of any small stocks. I don't know, VKTX, not necessarily super small, but okay. So this is 15 cents wide. At the open, it could be 30 or 40 cents wide. But in the split second, like microseconds, less than 1 second, before your human eyeball can see it, but computers can see it, what will happen is, let's just say you had a stop at 150. For a microsecond, the market maker can make this market $1, $2. And guess what? Your stop is now the mid. And because your stop, if I put in a stop, okay, if I put in a stop, what is it stop at? It's stopped at the standard, which is also mark, okay? Or if I do a stop limit, okay, standard or mark. Standard is mark, basically. So now that option is marked at $1.50, your order gets triggered, and the market maker says, okay, you're in between my prices. I'll transact at $1.50. Bam, you're out. A second later, microseconds later, a minute later, whatever, they tighten their bid-ask spread to $1.76, $1.91. They just took you out. Has nothing to do with pushing the underlying around. Okay? It's the liquidity, the bid-ask spread. They can just pop it out, take you out, and then pop it back in. And that's why we don't put stops in, unless it's something that is very hard to manipulate, which is basically SPY. Everything else is pretty easy to manipulate. You could argue maybe QQQ and IWM, but mostly just SPY. All right. Okay. That's not what Lance teaches in the 4 p.m. payout. Sometimes it's easier to explain things in a way that people already know and understand, rather than completely blow their paradigm, okay? So why is the market maker move? Why is it that if you use it, that you will win most of the time, okay? How often will you win? Depends on how you're using it. But the definition of that market maker move is it's a guess. It's a proprietary formula owned by, I believe, by Thinkorswim, but also Tasty Trade has it. But it is basically whatever the nearest expiration, so this 0 expiration, and I take the at the money call and the at the money put, and I add those together. So this is roughly 40 cents, roughly 60 or 70 cents, so roughly $1.10. 1.07. You see that? Because at the money, how much can it go down, or how much, basically this is 100% extrinsic value. So that's how much the market maker has cushion for, plus or minus, okay? 70 cents cushion to the downside and 40 cents cushion to the upside. And so we call that roughly the market maker move. So anything outside of that range, the market maker has potential to lose money specifically on that stock, assuming they didn't hedge themselves. Okay, but they hedge themselves. They'd be out of business instantly if they didn't hedge themselves, because they'd be losing too much money all the time. So why is it that we hit those levels, sometimes turn around? Okay, and why is it that it looks like those levels get defended? Okay, it is a couple of things. First, that market maker move is based on standard deviations. So this would be one standard deviation. You should have roughly a 70% chance right here, if all you did is just the market maker move. So statistically, you're already on the winning side, set by about 70%. The other thing is the same reason why Fibonacci's appear to work. It's nothing to do with there's some natural order in the market that says magically they should move and bounce at these levels. It's because enough people are looking at it that they form their expectation around it. And so you'll see a lot of trading happen around these levels. So when we get to a $1.08 move, a lot of people who transacted right now, when it moves $1.08, they're going to go, oh, I better stop myself out. Oh, I better, right? If you bought this 620 and it moves $1.08 and down against you, okay? I better sell my put. Is selling your put bullish or bearish? It's bullish. If a whole bunch of people sell their puts right there, sell their calls right there, then it'll bounce. It's just normal supply-demand market dynamics. That looks like it's magical. That looks like that people don't understand, and so they go to a conspiracy theory. Anything that people don't understand, they will. It's called a cognitive dissonance. It's something they don't understand. They will work very hard to try to explain it. They don't understand supply-demand dynamics. They don't understand the financial markets. They reach for the easiest explanation. Oh, the market maker's in control. The market maker doesn't want to lose money. It's pushing the price back. Okay, that's how conspiracy theories develop, because it seems like very logical. It makes a lot of sense. Seems very plausible, and we attribute, due to our lack of knowledge, that the market maker actually has that power. But there's actually a different explanation that is equally plausible, but is actually fact. Okay, that's actually how the market works. Okay, because market maker just doesn't have that ability, doesn't have that power, and they don't have that incentive either, because they're hedged. Right? So if you didn't know that market makers hedge themselves or how they hedge themselves, and you didn't know that they're not allowed to be the underlying, and you didn't know that their business model was just making this bid-ask spread on huge volume, then you might think that, oh, they're going to manipulate the underlying. No. Okay. There's a much simpler explanation once you have all the facts. Yeah. All these people who are afraid they're going to lose money are going to close their positions. It's that simple. Okay. So it doesn't matter how we explain it. It doesn't matter that, when we hit the market maker move, a lot of times it turns around. It doesn't matter why. If you're looking for the results from your trading, the why actually doesn't really matter. All that matters is the phenomena that it actually does. So there are some times why really matters, and other times it does not matter at all. 0, 0, 0, 0. Okay? I drive down the freeway at 100 miles per hour and a cop sees me, I'm getting a ticket. And I'm like, why? There's no cars on the road. There's no one there. It's 3 a.m. I'm the only car on the road. My car can handle it. I can handle the speed. I'm driving very safely according to my definition. Why am I getting a ticket? Why is the speed limit set at 65? Doesn't matter. It is. You're going to get a ticket. Doesn't matter. All that other stuff that you think matters, it doesn't matter in the eyes of the law. Okay? So we have to understand when to care about why and when to not care about why and just care about the phenomena. And in this case, the fact that most of the time prices stay within that market maker's move, I don't care why. I don't care how. I don't care how that market maker determines this price right here. How do they know that it's going to stay within this price? Their models are hugely complicated. They have supercomputers. They have teams and teams and teams of PhDs figuring this stuff out. I don't care. All I care is that's the number. That's the number that they gave me. And that number is proven true by far most of the time. So I'll trade that number. Okay? I don't care why. If I dig into why, I'll never get to the trade. So I just take the trade. Okay. So, I mean, if other people want to explain the hows and whys of it, let them, right? All that matters is the actual, the phenomena and what that means for our trading. Right? Okay. I have an option at a 47 strike and the stock is at 49, but you're still in the negative. When will it be positive if you reach expiration? Well, if you're going to hold to expiration, then it will reach positive. So how much did you pay for that 47 strike? Obviously, you paid more than $2. Otherwise, you'd be in the money right now. So if you paid $5, you're not going to be in the money until $52. So it just depends on how much you paid for that option. And that goes directly into what we were speaking about right here, implied volatility. Implied volatility will directly affect extrinsic value. That plus time value are the two major components of extrinsic value. And that will determine. So for example, this 620, if I buy it right now, it's got to go above 620.47. Otherwise, I'm not making any money. Okay. All right. Why my limit order is natural and I still don't get filled? If you're on a spread, you might not. If you're on a single, you should get filled on a natural instantly. If you're on a spread, it could be just the dynamics of the computers, because they're not necessarily trying to get the two different options or 3 or 4 different options from the same place, or they're trying to try to get it all from the same broker, and they're calculating that to be the natural price because they're taking the ranges. But the real promised, so if I want to do this vertical right here, this 620, 621, okay, I would have to go in and say, I want to buy this, so I got to pay 47 cents. And then I want to sell it here. I can only sell it for 16 cents. So my natural should be 31. Okay, 31. And you see that that's 30 and it's bouncing around 29. So that bouncing around makes it harder for you. So if you stick to that natural price, as long as it returns to it frequently, you should get filled. And then if you can't get filled, then you would just do them individually. You do the buy first, then the sell individually, and then you'll get that natural price. Okay. Let's see. Okay. All right, looks like you guys are starting to get it and it's making sense to you guys. Good. Good, good, good. All right. What it means to be in the money or out of the money. It means that your option is actually worth something other than speculation. Okay. So for example, the market is, let's call it at 620 right now. This 600 strike is worth $20 because if I exercise it, I can buy shares for $600, then I can immediately sell it to the market for $20. Again, just pretend this was pegged at 620, okay, not bouncing around at 619 and a half, okay? So that is it's worth $20. So that's in the money. At the money means it's worth perfectly zero. So if this was 620, this 620 strike would be worth exactly zero because I could exercise it, buy shares for 620, and then turn around and sell it to the market at 620. I make zero money if I do that. So that's at the money. And then out of the money is it's not worth anything. I can buy at 623 and sell to the market at 620. I lose money, so it's not worth anything. Intrinsically, it's not worth anything. Okay, let's see. Can I discuss for a moment when to order a debit or credit spread? Okay, I can explain it my way, and I can explain it the way that Tony Saliba agrees with me on, but a lot of other people, including Roger, will tell you something different, okay? So just understand that. For me, mathematically, pure math, no one can dispute this. I don't care what anyone says or how big of a name they are. They cannot dispute the mathematics. Mathematically, a credit spread and a debit spread are the exact same thing. Okay? So there's no reason to choose one over the other. Volatility, don't care. Mathematically, they're exact same. Time value, doesn't matter. Mathematically, they're exact same. If I'm trading same expiration, same strikes, mathematically, they're exact same. So it only comes down to one of two things. So if I do a debit spread right here, 619, 620, I buy that vertical, I can buy it for 55 cents, I have 45 cents of profit potential. If I do it the other way around and I sell this vertical and I do a credit spread, it's the exact same thing. I can make 45 cents, I can lose 55 cents. Exact same, okay? It just changed a little bit. If the prices are exact same, then they're equivalent. Take your pick. My favorite is the debit spread because I'm not gonna go into it, but I'll just let you know that I don't have fears of assignment if I do a debit spread. And also everything works in the same direction as every other trade that I have. I don't have to reverse the math in my head. Oh, this was a credit, and all right, okay. The longer longer I have it, the more, right? When I sell it, when I collect the debit, the smaller price I get is better for it. No, so that's the opposite of all my other trades. So then I have to track out, oh, this one's a credit and this one's a debit, and then it's very easy to get confused. And if I have dozens of positions or hundreds of positions, then you're going to confuse yourself really, really easily. So you just go with the debit, in my opinion only, okay? And then also, your brokerage is going to lie to you. If you do a spread, a credit spread, so let me find a credit spread. Okay, so these are, nope. Here, these are iron condors, so they're for credits, okay? So this tells me that I made 23% on this TLT spread so far, and it's false. I didn't make 23%. I made 23 of the maximum that I could make. This is not the return on investment. It's the return on the maximum return. So your brokerage is going to lie to you in all sorts of ways too if you don't get your head straight on it. So for me, it's always simplest just to go with the debit spread, unless for there's skew in the market and I can get way more money for the credit spread than I could profit potential in the debit spread. Okay, that's my answer. You know, other gurus will disagree with me, but mathematically, no one can dispute me. Mathematically, they are the exact same. All right. Market maker, a set framework rests up to algo programming to change prices. A lot of modern times, yes. Okay, so it's not a human making these decisions. A lot of them is algorithmically driven, yes. Okay. For morning payout, I do a stop order, and that's only because it's on the SPY. If it was anything else, because SPY is very difficult, almost impossible for anyone to manipulate, including the market maker. The market maker cannot make the bid-ask spread too wide because there's always going to be someone else other than the market maker that has a tighter bid or a tighter ask. So the market maker has very limited ability to gap these out because with the hundreds of thousands of contracts that are out there, there's going to be someone else who's going to be in between. So it does the market maker no good to widen out their bid-ask spreads if there's someone else in between, because the actual market is just going to be inside of the market maker's market. Okay. Futures operate market makers also. Yes, they do. Okay. Okay. I love the idea. Having both is confusing. However, several programs are credit spreads. How do you fit the credit into a debit spread? Yeah, whatever. If they're verticals, right? If, for example, if they say, oh, let's buy the 610 put, or sorry, sell the 610 put and buy the 609 put. Okay, then you would say, okay, I'm just going to go over to the call side, and I'm going to do exact opposite. I'm going to sell the 609 put or call and buy the 610 call. So you just flip everything. You flip calls and puts, and then you keep the exact same strikes, but you flip if you're buying or selling them. Okay. Marvell just dropped $4 on large volume in less than 5 minutes. Let's take a look at that. How are we doing on time? We're almost Marvell. I don't know their ticker symbol. Okay, but in context, right, their ATR is 3.5. So if they drop $4, then it's still within the intraday range, right? They didn't make a new low on that drop. So it's just intraday activity. So unless it breaks below the low and below this EMA 8, I wouldn't put too much significance into it. Natural price is the price that guarantees the transaction. So if you're buying, then the natural price is the ask. And if you're selling, then the natural price is the bid. Assignment is a major consideration for small account players to choose debit spread over credit spread. Yeah. Okay. When is it difficult to close a credit spread because of wide spread bid ask? Do you recommend closing the short and long separately? Yeah, that is a little bit more advanced. I'm hesitant to just blanket tell everyone to do that because it just depends on how comfortable you are. Yeah, so you would close the one that you're short first and then close the one that you're long. Yeah. Nathan says, from my previous understanding, but that doesn't matter with what you just explained. Nathan said, oh, to me, the only time to consider credit spread is when premiums are too high. What do you mean by premiums too high, though? Are you saying that implied volatility is really high? Because mathematically, they're the exact same. Just like it doesn't matter when implied volatility is high or not. The debit spread and the credit spread are going to give you the exact same profit for the exact same risk. So the max gain and the max loss are going to be the exact same. Your break-even point is going to be the exact same. Your profit curve is going to be the exact same. So the only exception is if there's skew. And if there's skew, that's also going to show up in the price. So if I can do the at the money spread for 50 cents over here for 50% risk and 50% gain, or 50 cent risk, 50 cent gain, but over here I can get 60 cents profit and 40% risk, or 40 cent risk and 60 cent profit, then go for this side, the credit side, because it's being priced differently. There's skew in the market. But when there's no skew, which is most of the time, or if the skew is only like a penny, then mathematically they're basically the exact same. So you will make the same amount of money in the same amount of time given the same price movement. So and same volatility movement. So they're really no different. Okay. All right, we are closing in on the hour. Didn't really get to talk about volatility regimes, but maybe I'll do that tomorrow. So Barry has a good question. I'm not sure how many know how to do. When you give us the morning payouts, how do we put in a target price and stop loss? So I'm not going to go into specific stuff in programs in Roger's VIP room. But basically, you need an OCO order or a bracket order, and then you can put in a stop loss and a target at the same time. Do I plan on trading potential volatility next week with tariff issues? So what that falls into volatility regime stuff. So that's an interesting question. So do I plan on trading potential volatility? I'm not expecting a huge amount of volatility issues. I think the market is mostly over it at this point in time, unless it's a huge major issue, right? Then maybe. Yeah. Okay. Who does these shakes, or is it big spike down and some spike up? Normally, huge movements like that these days are caused by algos, and then it's not actually people. Yeah. Okay. Does a debit spread work for Iron Condor as well? No, unfortunately. No. Yeah, some gurus say when options are expensive, they're saying high IV, but they're wrong. Mathematically, they're exact same. They're just wrong. I have no other way of saying that. They're wrong. Mathematically, they're the exact same. There's no reason to look at implied volatility and choose credit spread over debit spread, or vice versa. Okay. Can I talk about IV and IV rank? We can talk about that tomorrow. All right, guys. All right, we're going to end that here. I think, do we have, who's on with Blake? Do we have I was told that we have a replay of, so if you want to hang out, if you want to check out my morning payouts program, we talked about it a little bit yesterday. It's been killing it. We added another win today. Has huge potential for compounding. So if you want to hang out and for that presentation, please do. I've got to go and trade. Actually, no, I have a little bit of time, but actually, let's see. I remember your options chart illustration to the non-difference between debit and credit spreads. Yeah, absolutely. Yeah. 600 this morning on yesterday's trade. Excellent. Great job. If you just look at the bid-ask spread inside, if you want to do a credit versus debit spread, you could do that also, because what will a lot of times in the money options have a wider spread than out of the money options. So that could be another reason why you might choose a credit spread over a debit spread. Okay. Okay. So Blake, if you want to get that started, if you guys want to hang out and learn more about the morning payout program, it is probably right now my hottest program. People are loving the profits that they're getting from it. I actually personally, I showed the VIP members yesterday. As of this morning, I've officially, in less than 1 month, doubled a small account from 2,600 to over 50, actually 5,700 now, utilizing that methodology for my daughter, my younger daughter, so as she wants to save up for college. So it's a really great program, very, very, very consistent. So if you're not in the program, I do highly recommend checking it out. Stick around for that replay, because it is an excellent program, especially for compounding small accounts. Yeah. Okay. Okay, so if Matt, if we could cut YouTube, and Blake, if we could get that replay started, that'd be great.